Hello, Business 630 Remote Wednesday class. This is Professor Hassey speaking to you again from rather warm on this Tuesday, June 15th, Claremont, California in Finance Central. And this is our introduction video to week number 2, our remote session on Wednesday, June 16th at 6 p.m. And our topic this week is risk and return. One of the key points of finance is being able to find capital where the risk is minimal and the cost is cheap. If you're an investor, is the risk minimal and the return is high. Thus the dilemmas that we all face as finance managers. We'll be talking about our portfolio review, reviewing our portfolio and the discussion post, which is due this evening, Tuesday, June 15th. So make sure you complete that. Also, we have professor meetings scheduled with the students Friday, Saturday, and Sunday at the end of this week. Make sure you sign up for a meeting for that. Remember, this is a graded assessment, so you must meet with me. If you cannot fit into the schedule that I provided for our class, just let me know and I will find some times which fits your schedule. Before we get started tonight, here's a quick video about risk and return.
Understanding risk and return. Looking around us, we find that different financial products such as fixed deposits, bonds, and shares give different returns. Why do the returns differ? To answer this, we must first understand the idea of risk. An important principle of investment is higher returns entail higher risks. Risk drives the returns on assets. Fixed deposits earn the lowest returns because they are considered the safest. Shares have the highest expected returns as they are the most risky. Investment-grade bonds have expected returns lower than shares because they are less risky than shares. In investing, there is no reward without risk. If an investment offers higher expected returns, it will generally have higher risk. Suppose investment A has an expected return of 3%. If investment A performs better than expected, actual return will be above 3%. If it performs worse than expected, actual return will be below 3%. Actual return will be 3% only if investment A performs as expected. The presence of risk or volatility means that the expected return can differ from its actual return. The difference between actual and expected returns is risk or volatility. A simple statistical measure for risk is standard deviation. The larger the standard deviation, the greater the overall risk of an investment. Compare investments A and B, which have the same expected return of 3%. As B has a lower standard deviation than A, it will give a higher return to volatility ratio known as the Sharpe ratio. In investing, we aim to maximize the Sharpe ratio, which maximizes return for the same risk or minimizes risk for the same return. Further, to be successful in investing, you must understand your risk appetite. Assess your risk appetite on 3 dimensions: needs, ability, and willingness to take risk. If you plan to retire by 40, you would need to generate higher returns that will allow for early retirement. If you have dependents, your ability to take risk is likely to be lower than someone with no dependents. If you have the need and ability to take on risk, but find it unsettling after buying a risky stock, then willingness is low. You may want to consider investments with a lower risk profile such as investment grade bonds. Imagine investing as choosing a roller coaster ride. If you choose a wilder ride than you can handle, you are likely to want to get off the ride halfway, as it is scary when it dives. Similarly, if you have investments that are too risky for your risk appetite, you may panic and quit them prematurely when the market dives. The key to successful investing is the ability to stay invested. If you get off the roller coaster halfway, you could lose your investments. By staying invested, you may also ride out market volatility and business cycles. In the next video, find out more about portfolio diversification.
That video took the perspective of investors, of which this is not an investment management class, but I wanted you to get the drive behind investing, because the other side of the street is financial management. What the company has to provide so investors feel low risk and high returns. That's the goal of the company, to provide cash flow and profits and return to their investors, at the same time managing the risk of the company and keeping their costs down. That's the subject for our class this Wednesday evening, risk and return. We're going to look at risk and return in the context of our first four chapters: time value of money, debt financing, stock financing, and look at risk and return in all these things, because it gives us a base by which we proceed with our corporate finance study this summer. So please go to Blackboard and make sure you have signed up for you have finished your discussion work for this week, which is in week one file folder, the discussion with your bio, and pick a stock portfolio. Some of you, please check my notes back to you in the discussion forum. Some of you need to resubmit your spreadsheet. And then in week two is the setting up of our meetings for this week. Notice some students have blocked out Friday already, but we have Saturday and Sunday available. If you cannot meet at those times, please let me know and we can arrange another alternative date and time for you. But you must see me this week. So again, that's our plan for this Wednesday's class. If you cannot attend or make class this Wednesday, please let me know in advance so I know about that. And looking forward to working with you all and talking with you all at the end of this week. So we'll see you all Wednesday evening. Until then, adios.